Hello and welcome to the latest episode of On the Money, a weekly look at how to make the most out of your savings and investments. In this episode, we're focusing on private equity, a part of the market that retail investors cannot access through the regular stock exchange. Over the long term, there have been some strong performing private equity investment trusts, but over the short term, it has been a more challenging period for some of those trusts in the sector due to interest rate rises, which has created some uncertainty and some mistrust over the underlying valuations for the assets held in private equity trusts. To address these concerns that some investors have is Stephen Tredget from Oakley Capital Investments, which is a private equity investment trust. Before we get to that topic, Stephen, could you summarise your approach to investing in unquoted companies?
Certainly, and thanks, Carl, for having me on the pod. So, as you say, OCI, an investment trust that just invests in the Oakley Capital funds. And then Oakley Capital, its strategy, so it's a private equity manager, as you say. It focuses on taking controlling stakes in fast-growing private European companies. And it has a kind of 5-pronged strategy, which I'll kind of go at speed through in terms of the kind of criteria it looks to meet when making an investment. Firstly, I mentioned kind of private European companies, and they have to be in one of 4 sectors. Those sectors are technology, education, consumer digital, and business services. Secondly, and this is the kind of edge for us, this is our kind of angle, it's the fact that we back founders. And that produces 2 things. We can go into origination more shortly, but the key thing they provide is, one, means that we're backing an existing successful founder who is going to have the same alignment as us. They're going to still retain a significant equity stake in the business. And when they look to bring us on board as a partner, we're often the first partner they've ever brought on, institutional investor. So in 90% of the cases, we're the first institutional buyer into that business. And in 75% of cases, we are backing a founder. And what that delivers for us is not only alignment and success. Our realized returns to date are 4.5 times money multiple since our inception. But it also gives us a really interesting entry point when we join a business which, although successful and although profitable, has a heap of organizational maturity which we can help them with. And so we come up with a whole bunch of complexity that we have to navigate, and that's great. It means there's a whole bunch of value we can get ourselves around. Risk is often reflected in the price. We often get in a kind of interesting valuation. And it's also a business that's not ready for an auction. And so as a consequence, we're having a bilateral discussion with a founder whose key interest is not necessarily price maximization. So we get in at really interesting valuation points. The other 3 criteria are, 1, we're looking for digital disruption, businesses that can grow by taking market share rather than relying upon strong economic backdrop or an overall market growth. And we're looking for recurring revenue. We either want to establish it through subscription, or we want to kind of back a company that has that kind of visibility. And then the final 2 are, we're looking for some kind of mega trends that we know are going to endure. It could be the consumer shift to online solutions, business shift to the cloud, or the kind of growing global demand for high quality and accessible education. And then finally, and here's the key for any private equity investor, particularly in the small to mid market where we focus, is that we've got to somehow positively be able to impact the outcome. Hopefully you get in a sense these are growth businesses. We're not looking to kind of take cost out. We're often looking to invest into those businesses and help them grow. And how might we do that? It might be through M&A, it might be the increase of talent, it might be digitalization, often it's internationalization, or helping them grow to be the leading independent player in a particular market.
So how many of the businesses in percentage terms held by the investment trust are profitable?
All of them.
All of them?
All 32, yeah.
And in terms of recurring revenue that you mentioned, are there any key ingredients that you're looking for you to establish that, all things being equal, that company, those recurring revenues should continue and should strengthen in the future?
Yeah, as I say, nothing quite beats subscription. I mean, on one side of things, you've got education. Well, there's a very clear example of customer loyalty and a subscription of sorts that kind of goes through the life of a child's schooling. And, we cover education from early years through kindergarten to year 12 up through to university and tertiary education. And, in K-12, school fees are one of the last things, if you can avoid it, you cut as a parent. Now, there's obviously other methods of subscription. If I give you an example of one where we've introduced subscription, we invested in a business called Tech Insights, and Tech Insights tears down at molecular level semiconductors in mobile phones. And what historically it's done that for is to provide, let's say, Apple with an understanding of the IP that's being used within Samsung's latest release. And what it wanted to know is, was our IP being infringed? And if it was, it would use that information and pay a significant amount of money for it to then defend their IP in a court of law. Not a bad business model, but a very lumpy business model. And it very much depended upon the product life cycle. And if you had lots of products out, you might get lots of project revenue of that kind, but zero of it was recurring. How we transformed that business was to say, look, you have this incredible depository of data around all the major semiconductors in most mobile devices. Rather than just focusing on project revenue, how about create a subscription and access to a library of information that you can sell to a much wider audience, and you'd have this kind of recurring revenue. And we went from 10% recurring revenue to 65-70% recurring revenue, and 200 of the largest OEMs in the world now subscribe to that information. You can imagine the valuation shift you get from kind of going to one-off revenue to kind of repeatable.
And nowadays, there's a greater tendency for companies to stay private for longer. If it's a business that you own that then does decide to list on the main stock market, do you then sell it?
We don't really have an example of that. So would we? Yes, typically, but there's so many other variables we're unaware, we don't know at this point. And also answer that question. Historically, the majority of the businesses that we exit to a large sponsor or strategic. So we are typically the first PE firm manager into growing private companies, and then we're preparing them for sale to the large global PE firms. So our last 8 deals were sold to big household names you'd recognize, 2 to CVC, 1 to KKR, 2 to Silver Lake, 2 to EQT. You get the idea. We've kind of got them to a certain stage in professionalization, and then it's about them going onto a global stage with a backer with maybe much deeper pockets. It may be that we think it's still worth having exposure to that. We might keep a minority stake in order, because we know that company so well. We've got this massive information advantage. But typically we're looking to exit the business after a 4-year hold period.
And could you name an example or two of a company that you backed at a very early stage that is now more of a household name?
I might struggle for household names within the UK. I mean, we've typically the household names, funny enough, have been in Germany and in Italy, where we backed kind of consumer digital platforms. So for example, we backed Verivox, which was a price comparison website in Germany, Parship, which was an online dating platform in Germany. And they're like backing here in the UK, kind of Money Supermarket and, kind of eHarmony or Match.com, that scale of business, which would have gave us a lot of exposure in those regions. We also took our learning from those kind of platforms and then went to other jurisdictions like Italy, for example, where online solutions are much less penetrated. I mean, incredibly, in Italy, only 40 to 50% of Italians have done any kind of e-commerce. So you can imagine price comparison where, let's say, 90% of car insurance is arranged online in the UK, 80 to 90%. In Italy, even after COVID, it's more like 15%. And so you combine to these businesses where you're not taking a bet on the Italian consumer, you're not even taking a bet on car insurance or broadband, you're just taking a bet that there will be the steady adoption of an online solution over time. And that's exactly what's happened. Factually, the business we're invested in Italy has grown 20% every year for the 10 years we've owned it, as more people are adopting that solution.
And as mentioned in the podcast introduction, there has been some mistrust over the valuations of the underlying assets held by private equity investment trusts due to the fact that interest rates have risen. Some investors have been sceptical about whether the valuations have repriced sufficiently to factor in those interest rate rises. What are your thoughts on these concerns? Are they overblown? Are they justified? What do you think?
Well, I'd add to that. I'd add to the other reasons why people are concerned about it. I mean, first of all, there's a sense that, we saw a couple of years ago the stock market really retrenched quite quickly, and particularly tech stocks. And there was some sense that the private equity valuations didn't keep pace with that. And there was accusations of volatility laundering. And then there's kind of talk of Ponzi schemes that, kind of private equity is often buying from itself, going from fund to fund to sustain a valuation. And then, of course, you kind of got prior mistrust of the industry. and this idea that it's very closed door, that you don't really know the backers behind it, etc. And so the list goes on, and it kind of begins in the 80s with that kind of vulture mentality that was associated with private equity. So how do I unpick that in a kind of 30-second answer? I think first off, one, private equity is a quite diverse and now increasingly large asset type. And it goes from all the way from venture capital seed all the way up to large, kind of global PE. And so kind of capturing a view for the entirety of that asset class is also difficult. Don't tar it with a single brush would be my first point. Secondly, and particularly when we look to the listed PE space, I think the participants are very high quality. Personally, have invested in and would invest in the majority of those names. They're incredibly well run with good discipline. And if I talk about some of the things that can reassure us, firstly, the majority of them adopt quite strict guidelines on valuation. It's the IPEV, the IPEV guidelines, which ensure that you're not valuing at the top end of ranges, you're doing conservatively, and you're basing that valuation off the price you pay. The tricky thing with private assets is you only truly know the valuation of the business when you buy it and when you sell it. And if you've done, kind of months and months and months of due diligence to establish the right price to buy the business, that valuation should really be the anchor for how you value that business, unless something material has changed within the markets. The other thing I would say is the stock market versus, let's say, the FTSE 250 or the FTSE 100 or FTSE All Share even, compared to our portfolio of 32 companies, are distinctly different. Private equity is typically backing, and it represents about 20% of the GDP of the companies that form the GDP in the UK are backed by private equity. And they are typically new economy, fast-growing businesses. So you should have businesses that are way more resilient, often don't have a listed peer. And if you remember, when we've got into these businesses, we're typically getting in 20-25% below what a market rating would be. So I'd say, one, don't assume because the market's gone down that these businesses have dropped in value. We don't have clear comparisons. Two, that we should be a fair amount of white space between us and the public markets. And then let's get to your point, which is interest rates and how they've affected them. Look, clearly a greater cost of capital is going to reduce your ultimate return. But in our case, it's relatively tiny. Our target returns, that's how essentially our base case return that we underwrite when we make an investment, is that we're going to make 2.5 times our money gross. That's the outcome we have to achieve, and we have to achieve that in a relatively high interest rate environment and a kind of early 90s style recession. And so consequently, if you think about those returns, and despite that, the cost of capital is relatively low in terms of its ability to impede that return. We tend to be quite cautious anyway on the use of debt for medium-sized, small and medium-sized companies. Our average net debt to EBITDA is about 3.9 times. Now, that maybe seem high versus the public markets, but actually compared to the private markets, which average more around kind of 6 times net debt to EBITDA, we take a relatively conservative approach. And so we're not using a lot of debt, and the kind of returns that we're targeting really aren't going to be impeded by debt. And just to bring that home, if I think about our returns and what drives the returns, 50% of our returns, realized returns, have been generated by organic EBITDA growth. 25% is multiple expansion. So buying a business like Tech Insights that I mentioned, the semiconductor IP business on single-digit multiples, let's say 7 times, and selling it ultimately on the 15, 16, 17 times kind of 4 years later. Then a further 15% is thanks to M&A, which is a big part of our strategy. And then finally, 10% will be the use of debt. It hasn't historically really driven our returns, and therefore a high cost of it is not necessarily going to limit our returns too significantly either.
So for those 32 holdings held by the investment trust, how often are you reevaluating the valuations? And is it all done in-house, or do you use third parties as well?
Yeah. So we have a team dedicated to make those valuations in-house in Oakley Capital, and they reevaluate the value of those 32 businesses every quarter. And that is kind of done by the team and then reevaluated by the fund finance team within Oakley Capital. Then once a year, Oakley Capital Investments, the investment trust OCI, conducts its own independent valuation of the 32 companies and compares and contrasts with Oakley's proposed valuations.
And you mentioned that in a number of cases, there's not a listed equivalent to compare against. So do you approach those sorts of situations differently?
You try to get as much information about similar businesses as possible. Now, clearly, if there's been a transaction in the space with a business that looks and smells exactly like it, well, that's a really strong indicator as to how that business should be valued. So you're looking at private and public peers. You're going to weight slightly more to transactions, and you're going to look to see what they're held on a number of different variables. You're not going to rely upon an EBITDA multiple or just a revenue multiple. It's what's most appropriate for that particular company. The thing I would say on the topic, and slightly as an aside, with private equity, you're not incentivized by the current valuation of the business. You're only awarded any kind of performance fee at the point in which you realize the business. And so there's very little incentive to kind of hold the business too high a valuation. So we tend to be quite conservative on that point. And also when you announce the sale, whether that's and that's to any of our investors within the funds, you typically want that sale to be at least at, if not at a significant premium to the book value, to give people that confidence in the underlying company valuations.
And my next question might be a bit of an unfair one, really, because I think for the whole industry as a whole, what do you think needs to be done so that, retail investors can put more trust in private equity valuations?
Yeah, look, it's not an unfair question. It's a great question, and it's the one that we spend so much time pontificating on, because we obviously know that underlying your question is this idea of discounts, and it kind of reflects that uncertainty, we can assume, as well as there's a whole other host of reasons why a discount may prevail. We're fortunate, with only 32 businesses underlying, we can give quite a lot of information about each of those businesses. We can break them down. We can give you some sense of their performance. If you're listening to our annual AGM, you can hear from the CEOs of those businesses, and we can help people kind of build, even retail, with a certain amount of the information we provide. We certainly give analysts, this extra detail. We can help them build a sense of the strength of the underlying net asset value and the direction of travel for that net asset value. And you've seen it across all our peers. There's also a kind of an increasing willingness to provide KPIs to help you get a kind of snapshot of the health of the business. What's the average growth of the companies? What's the average debt within those businesses? What's the average valuation you're being held at? Just ways in which you get a sense of, okay, does this feel like the right kind of valuation, given these businesses are growing on average, kind of 15%? There's a 16 times money multiple, given the quality of those earnings, feel about right. And then there's a lot more description of the businesses, the kind of sectors we're exposed to. And then there's history. Has this investment manager been sensible in their valuations, and have they produced fairly consistent returns? The one thing I would say to any investor, don't focus on the discount. The discount it's not going to determine your shareholder return on a year's basis. If you look back to previous shareholder returns and the three best performing listed PE trusts, okay, one of them was at a premium to their NAV over that period of time. There was ourselves at a discount, and the second that traded roughly around par, around their NAV. So quite large disparity in the discounts, but the single thing that drove all of them was the growth in NAV per share. And that's the thing you need to focus on. In terms of where you get increasing confidence from as a retail investor, is look at a number of things. One, look at businesses that are realizing their assets on a regular cadence. What you'd be worried about is if the average length of hold is getting longer and longer, suggests there's maybe indigestion within the business, they're not finding buyers for those businesses, or they're not finding the right price, and they're under pressure to keep holding those businesses until they seek the price. They get the price that they seek. So look at that relative cadence of kind of realizations and where are they being sold at or around the NAV or a premium to the NAV. And there's a number of trusts that continue to achieve that, even in a relatively soft kind of M&A realization market that we're experiencing at the moment. The other thing as well is that there is an increasing secondary market for fund positions. And when I say secondary market, so OCI has primary positions. It's invested in the Oakley funds, same as every listed investment trust. There is now a market in which you can sell positions in funds. And a number of those transactions are happening at the moment, and they're happening at NAV. I mean, there could be no better kind of reassurance for the retail investor that someone with a lot more information than them is buying stakes, the stakes the investment trusts have at the price in which they're advertised at.
You mentioned that over the long term, the key driver is the performance of the underlying investments, the net asset value. Now, over 3 years, Oakley Capital Investments is up over 60% on an NAV basis. Now, the share price total returns have been good as well, around 40%, but there is that gap between the two. Do you expect over a longer time period, say 10 years, that they will be a lot closer together?
Yes, is my short answer. Now, what underlies my confidence? I think there's just natural reasons why the discount prevails at the moment. And some of them are structural. So some of them may just be, at the moment, investment trusts general, not just listed PE, but investment trusts general, most of the sectors will trade at an average discount. Small and medium-sized companies across the listed universe are trading at relative lows. So structure at the moment, small and mid-cap is just under a bit of pressure. Particularly it's the section of the market where when you've got outflows, and we've had 40 months of retail outflows. I mean, it's no wonder that end of the market is kind of depressed in terms of valuation. That will reverse. And we're seeing that because more and more retail are coming onto our register. Pre-COVID, the three main retail platforms were 3% of our share register. Today, it's more like 16, 17%, and it grows, year on year on year. The retail are coming for these assets, and they recognize it's an asset class that they really should have some exposure to. It doesn't have to be the only thing you have exposure to, but you'd want it in a portfolio kind of naturally. So there's that. I think there's increasing transparency and it's consistency of performance. When we were performing well over the kind of low interest rate to no interest rate environments in a generally strong economic environment, everyone kind of felt, understandably, there's a rising tide. Of course, you're all doing well when there's zero cost of debt. And then as we go through this more difficult period, I think most of the sector is doing this, and OCI particularly is proving that we can still generate returns, still on the basis of kind of cautiously valuing these businesses. There's trust in these managers, and they can control an outcome even in a difficult market. And if we can consistently prove we can grow through this period of time, then it really feels like there's going to be an awakening for the kind of listed PE. And with that comes more demand. The more we grow in scale, we're about an 800 million market cap business. Once we get into the kind of billion plus, kind of in your FTSE 250, you're going to see more trading, more liquidity, more chance for these businesses to kind of rate. And I think, kind of boards that kind of recognize the need for transparency, for good governance, for kind of careful capital allocation, all of which over time is going to slowly close the discount that these businesses trade on.
Of course, it's no panacea, but one tactic a board can use is share buybacks to try and rein in a discount or keep it under control.
Yeah.
Your discount is around 30% at the moment. Have the board been buying back shares?
There's 2 points I make. Firstly, before the answer is one, there's little evidence that a buyback closes the discount. A buyback should be done, and is the thing it can control, is that it increases shareholder return. It enhances the NAV per share. And that's the logic behind a buyback, at least the one I support. And OCI, of the kind of listed PE peers since 2019, has bought back probably the second highest number of shares amongst its peer group. So there is a history of us buying back. And we've typically said, look, when we've got excess cash, i.e. more cash than we budgeted, obviously you budget your cash levels and you commit to the funds in the future. And as the funds draw down your capital, you obviously have cash there waiting to be drawn down. If you've got more cash than you need, based upon those commitments, then we've always said we'll use those to return that cash to return to shareholders. Now, we're in a particular position at the moment when we probably have kind of broadly enough cash. We're using a facility within the business to support that, create extra liquidity. So we don't have the excess cash we would use to buy back at the moment, but the board is supportive of doing so if the opportunity arises.
Well, thanks to Stephen, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. If you get a chance, leave us a review or a rating in your podcast app too. You can join the conversation, ask questions and tell us what you'd like us to talk about via email on otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website, which is ii.co.uk. And I'll see you next week.